Yeah, it seems like the core markets, at least, are a little bit disappointed with this outcome. I think it's interesting because on some elements, I would say they were at least at the more dovish end of expectations. So that duration period that they've extended for PEP for and the TLTROs are kind of slightly longer than I think consensus was probably sat around the end of December 2021, and they've now announced it going into 2022. So I think what core markets are taking from this is actually that means a lower monthly pace of purchases, and perhaps that's what's causing the disappointment. On the flip side, though, I think it should still be bullish for periphery. You know, we've got this confidence that the ECB is now there for longer than we perhaps originally expected. And also, as you mentioned previously, this ease to the TLTRO terms, A, for longer, and B, a slightly bigger borrowing capacity should be very supportive for periphery, particularly at the front end, we think.
So I actually want to take it back to where periphery yields are trading right now. I mean, 10-year Spain, we have even trading in negative territory, Greece in negative territory, a whole bunch of these countries that were right at the epicenter of the sovereign crisis in 2012-13 are trading in negative yield territory. There is certainly a degree of financial repression that's going on here, a crowding out effect. The wealth has been transferred away from savers to debtors, and this is primarily a function of the ECB policies over the last 12 months. Is this asset purchase buying going to have unintended consequences later on down the line?
I don't think so. I think, you know, we view the ECB as being a very long-term investor, and what the shift, I guess, in the policy balance has been this year is that although they've expanded the asset purchase program significantly with PEP, that has almost been to meet or to create the space that governments need to spend on the fiscal side to get out of this crisis. So although we've seen a huge increase in the purchase scheme, that has been met by a big increase in the supply of bonds as well.
Now, Imogen, just looking ahead, we are awaiting the fresh economic forecast from the ECB set to be delivered just as Madame Lagarde begins speaking. And obviously a lot has changed since the last ECB meeting, in particular with regards to lockdowns, with various European economies going back into lockdown. At the same time, we've got positive developments on the vaccine front, which solidifies some of the optimism for next year. What does all this mean for the way the ECB is likely thinking about the economy next year and the recovery?
Yeah, I think you're right. I think given that the September forecasts were pre this kind of turn down in COVID trends and the November lockdowns, etc., we will see a slight downward revision to both GDP and inflation. Very marginal, but I think that they will be used to really justify this recalibration of policy. But we could well see a slight revision up of GDP in future years. And we'll also get the 2023 forecast for the first time too. On the inflation front, we expect that to hover around probably the 1.3, 1.5%. So some convergence from where we are now to their target, but still well below the 2% target. And that will really be the justification behind the policy recalibration today.